How a $7 billion company collapsed overnight. Carillion case study. In 2018, one of the largest construction companies in the United Kingdom suddenly collapsed. Not slowly, not gradually, but in a way that shocked an entire country. This company had billions in revenue, thousands of employees, and major government contracts. It looked stable, even successful, but behind the scenes, something was breaking. And almost no one noticed in time. Carillion was not a small business. It was a massive UK construction and facilities management company. It built roads, hospitals, schools, and major public infrastructure. For years, it was trusted with some of the most important projects in the country. On the surface, everything looked solid. But that appearance was misleading. First warning signs. The problems started when the company began expanding aggressively. It took on huge contracts. But many of these contracts had extremely low profit margins. At first, this didn't seem dangerous. Because the company believed future growth would make up for it. That assumption would later become critical. The system starts breaking. As time went on, costs began increasing faster than expected. But instead of slowing down, the company continued expanding. To maintain confidence, leadership relied heavily on optimistic financial projections. On paper, everything still looked manageable. But internally, pressure was building. Cash flow was tightening, and debt was growing. Crisis phase. By the time warning signs became obvious, it was already too late. Debt had reached dangerous levels. Profit margins were shrinking, and the company had started relying on future deals just to stay stable. At this point, Carillion wasn't just struggling. It was structurally unstable. Collapse. In 2018, Carillion officially collapsed. The company went into liquidation with over £1 billion in debt. Thousands of employees lost their jobs almost instantly. Government projects were disrupted, and investors were left with massive losses. The collapse was not just financial, it was systemic. Why it really failed? Carillion didn't fail because of one mistake. It failed because of a chain of decisions. Aggressive expansion, weak risk control, overconfidence in forecasts, ignoring early warnings, dependence on future growth assumptions. Each decision seemed small at the time, but together, they became fatal. This is exactly the kind of real business story I break down here. Not theory, not advice. Real companies, real decisions, real consequences. If you want more stories like this, subscribe. Because the next one is even more extreme than